Over the course of your working career, you have paid taxes into Social Security. The surprising part about that is that depending on how much money you make in retirement, you may have to pay income taxes on the Social Security benefit that you receive. The purpose of this video is to help you understand how that calculation is done. Stay tuned. The first thing that you should understand is why Social Security is taxed in the first place. During the Reagan administration, President Reagan tasked Alan Greenspan with figuring out how they could shore up Social Security. Social Security was facing a funding issue because they were paying out more than what they were actually receiving. So what they determined is that they should begin taxing Social Security benefits on those that made a significant amount of money in addition to their Social Security benefit. Now keep in mind, at the time, only 10% of Social Security recipients would actually be subject to income taxes on their Social Security benefit. The issue now is that over 40% of Social Security recipients are subject to income taxes on their benefit. And this has become a huge problem, especially when it comes to planning for your taxes in retirement. There are a couple of terms that I think you should be aware of when it comes to calculating how much of your Social Security benefit may be subject to income taxes. The first is your adjusted gross income, or your AGI, and this includes things like wages, pensions, and any investment income you receive from a pre-tax retirement account. Next is tax-exempt interest, and this is interest that is typically received from municipal bonds. There are other sources of tax-free interest, but for most of the people that find value in my content, any tax-free interest that you receive is most likely coming from a municipal bond. The final term that you should understand is combined income or provisional income, and these terms are used interchangeably and they mean exactly the same thing. But your combined income is what is used to help determine how much of your Social Security benefit could be subject to taxes. The equation that is used to determine that amount is your AGI plus your tax-exempt interest plus 1/2 of your Social Security benefit. Once the IRS determines what your combined income is, they're going to compare that to certain thresholds. If you're a single filer, if you have a combined income of $25,000 or less, then none of your Social Security benefit is going to be subject to income taxes. Any of your combined income that falls between $25,000 and $34,000, 50% of that amount becomes taxable Social Security income. And then for any of your combined income over $34,000, 85% of that amount can be considered taxable Social Security income. If you're married, then those thresholds go up marginally. Anything below $32,000, none of your Social Security benefit is subject to income tax. Anything between $32,000 and $44,000, 50% of that amount is subject to income tax. And then anything over $44,000 of combined income, 85% of that amount is subject to income taxes. Now, that's a lot of information and it's as convoluted as it sounds. And I want you to keep in mind that these thresholds haven't changed since 1984 when Social Security became a taxable source of retirement income. The easiest way to understand this is going to be with an example, and that's what we're going to get into next. So let's assume that we have a couple that is married filing jointly, and they receive $40,000 of taxable income. And this could be from a pension, it could be from a 401k, a 403b, but it's $40,000 of taxable income. We're also going to assume that they receive $36,000 of Social Security. The combined income formula is their AGI plus tax-exempt interest, which we're not going to assume any tax-exempt interest in this example, plus 1/2 of their Social Security benefit. This couple's combined income is going to be $40,000 of the taxable income that they received, plus $18,000 or half of their Social Security benefit. Their total combined income in this example is $58,000. Next, we're going to take that combined income and compare it to the thresholds of a married couple. So any of their combined income from $0 to $32,000, none of that counts towards their taxable Social Security benefit. Anything between $32,000 and $44,000, half of that amount is going to count towards their taxable Social Security. Their combined income is over $44,000. So the $12,000 that exists within this threshold, 50% of that is going to be considered taxable Social Security income. So we multiply 12,000 by 50%, That's $6,000. Then, any of their combined income over $44,000, 85% of that amount can be included as taxable Social Security. So they had $14,000 above the $44,000 limit. We multiply that $14,000 by 85%. That's going to give us $11,900 of taxable Social Security income. So if we add all of that up, their total taxable Social Security is $17,900. Now keep in mind, there is a cap on the amount of your Social Security that can be subject to taxes. That cap is at 85%. So if you do these calculations and the numbers add up to more than 85% of your Social Security benefit, you don't use these calculations. You simply take your Social Security benefit and multiply it by 85%, and that's how much of your benefit is taxable. So the next thing we're going to do is we're going to take that taxable Social Security number and figure out what their estimated federal tax bill might be. So we know that they received $40,000 of taxable income. We also know that $17,900 of their Social Security is subject to federal income taxes. If we add these together, their total taxable income is $57,900. We're going to take the $57,900, we're going to subtract from that $29,200 because this is the standard deduction for 2023. This is going to leave them with a taxable income of $28,700. We're going to take that amount and compare it to the marginal tax brackets for a married couple. Any of their income that falls between $0 and $23,200, it's going to be taxed at 10%. In their case, they fill up that entire tax bracket. So they're going to owe $2,320 on that income. The additional $5,480 of their taxable income, they're going to owe 12% of that amount. So we multiply $5,480 by 12%. That equates to $658 of additional taxes on that income. So their total federal tax bill with $40,000 of taxable income and $17,900 of taxable Social Security is $2,978. That's not a bad tax bill, especially if you receive $76,000 of income, but it's still a tax bill that could be avoided with a little bit of planning. So what we're going to go into next is what their situation would look like if they withdrew some of their money from a Roth IRA as opposed to a pre-tax retirement account. So instead of having $40,000 of their income coming from a pre-tax account, we're going to assume that half of that comes from a Roth. Their income is going to break down as follows. We have $20,000 from a pre-tax account, $20,000 from a Roth, and then $36,000 from Social Security. Now keep in mind, any money that's received from a Roth account is tax-free. It's not counted as part of your federal tax bill, and it's also not counted as part of your combined income. Combined income is AGI plus 1/2 of Social Security. Yes, tax-exempt interest is included, but for this example, we're assuming they don't receive any. So we're going to take the $20,000 as opposed to the $40,000 that was in example 1, and we're going to add to that $18,000 or half of their Social Security benefit. If we add both of those together, their combined income is $38,000. Now we're going to follow the same calculations as we did in the first example. Any of their combined income from $0 to $32,000, none of that counts towards their taxable Social Security benefit. The amount of their combined income that falls between $32,000 and $44,000, 50% of that counts as taxable Social Security, and then anything over $44,000, 85% of that amount will count. In the previous example, they had $14,000 of combined income that was above the $44,000 threshold. In this example, none of their combined income is over $44,000. They actually only have $6,000 of combined income that falls in that second threshold. If we multiply that by 50%, this means only $3,000 of their Social Security benefit could be subject to income taxes. So as opposed to the $17,900 that they could have paid taxes on in the first example, now they only have to add $3,000 to their taxable income. So now let's look at what their federal tax bill would be with only $3,000 of their Social Security benefit being taxable. So they have $20,000 of taxable income from the pre-tax account. They have $3,000 of Social Security that would be subject to income tax. This leaves them with a taxable income of $23,000. We take the $23,000, subtract $29,200 for the standard deduction. This is going to leave them with no money subject to federal income taxes. And although $3,000 a year may not sound like much, when you're planning for a 20-year or even a 30-year retirement, this could be an additional $60,000 to $90,000 of disposable income that you could use on the things that you want to do. And this is the importance of having a true retirement income plan. You have to understand how all of the sources of income in your retirement are going to play into your tax situation. I know there's a lot of information that's in this video that you may not have been aware of, but I think it's important that you understand that your Social Security benefit could be subject to income taxes. Understanding how this process works is how you can ensure that your retirement income plan is right for you. If this video or any of the other videos that I've put out is providing value to you, subscribe to the channel, like the video, comment on it. If you know someone that you think would get some value out of these videos as well, then share it with them. But I thank you again for tuning in. I'll talk to you soon.